This is the Just Alpha Weekly Market Recap for Friday, November 21st, 2025. It was a challenging week for major U.S. equity indices, with the S&P 500 falling by 1.92%, the Nasdaq 100 down 3.09%, and the Dow Jones Industrial Average decreasing by 1.96%. The Russell 2000, representing smaller companies, also retreated, but by a milder 0.79%. In terms of fixed income, the yield on the 10-year Treasury dropped by 7.9 basis points, reflecting a flight to safety amid the equity market's turbulence. Oil prices surged by 3.69%, while gold slipped slightly, down 0.48%. The U.S. dollar, on the other hand, strengthened, gaining 0.90%, indicating a risk-off sentiment among investors. The week was marked by a noticeable dichotomy in market behavior, driven largely by positioning dynamics and macroeconomic narratives. The bond market's decline in yields typically signals a retreat from risk, as investors sought safety. This was compounded by a thinning liquidity environment, which exacerbated volatility. Traders observed that dealers were short gamma, meaning they were inclined to sell into market declines to hedge their positions, which contributed to the downward pressure on the indices. In contrast, the uptick in oil prices may reflect ongoing geopolitical tensions and supply concerns, which have kept energy markets on edge. As we delve into the breadth and participation data, we see a mixed picture. The overall advance-to-decline ratio for all stocks was 10.14, suggesting that more stocks rose than fell, yet only 53.9% were above their 200-day moving average, a decline of 1.2 percentage points from the previous week. The mega-cap segment, which typically drives market sentiment, showed weaker participation with an advance-to-decline ratio of 1.94 and a notable drop in stocks above their 50-day moving average. In contrast, mid- and small-cap stocks demonstrated relative strength, with advance-to-decline ratios of 12.65 and 16.32, respectively, indicating a more resilient breadth in those segments. The substantial increase in the advance-to-decline ratio for sectors like consumer cyclical and financial services, which saw ratios of 23.20 and 15.63 respectively, highlights a shift in investor focus, possibly in anticipation of more favorable economic conditions ahead. This contrasts sharply with the mixed signals from the technology sector, where the advance-to-decline ratio was 6.89, and participation metrics showed signs of strain. The tech sector's struggles can be attributed to ongoing concerns about valuation and interest rate pressures, which have kept investors cautious. Intraday positioning also played a pivotal role this week. The price action was primarily influenced by macroeconomic factors, including ongoing discussions around Federal Reserve policies and inflation expectations. Notably, as volatility increased, market makers adjusted their hedges, resulting in a compression of volatility that weighed heavily on the indices. The resting buy programs around key moving averages, particularly the 20-day, helped stabilize the market during periods of sharp decline. But overall, the lack of directional conviction left traders hesitant. Cross-asset dynamics further illustrated a risk-off tone. The strengthening U.S. dollar suggested that investors were flocking to cash and dollar-denominated assets in anticipation of a slowdown. Meanwhile, the rise in oil prices indicated a complex narrative where supply-side issues are counterbalancing demand concerns. Gold's slight decline also reflects a market grappling with uncertainty, as traditional safe haven assets faced headwinds from a stronger dollar and shifting inflation expectations. Looking ahead, the question remains: will this week's breadth confirm ongoing leadership in segments like consumer cyclical and financial services, or will the pressure from the mega-cap and technology stocks reassert itself? As we approach the end of the month, investors will be closely monitoring earnings reports, economic data releases, and Fed commentary for further signals on market direction. The interplay of these factors will be crucial in determining whether the current breadth trends can hold or if we will see a retreat back towards the large-cap names that have historically dominated the market landscape.